Welcome to the deep dive. You give us your reading list, and we sift through it.
Yeah, we pull out the core ideas, the surprising bits, the really important stuff.
All condensed so you can get informed without, feeling buried under a mountain of research.
Exactly. And for this deep dive, we've tackled a really fascinating set of academic papers all about blockchain tech.
Right. Looking at consensus, smart contract languages, governance, quite a mix.
It is consensus protocols, scripting, security, even how these networks govern themselves. It's all in there.
So our mission for you, the listener, is to pull out a clear, kind of digestible understanding.
Yeah, grasp the key advancements, the ongoing research, find those aha moments.
Get a solid handle on what's happening under the hood, basically.
And these are proper academic papers, We're digging into the technical side, security thinking, new applications. They're guiding us through the next wave.
Okay, let's unpack this then. We're starting with, the fundamentals. Distributed ledger technology, DLT.
Right, and the scripting languages that make them programmable. That 2016 paper you sent gave a good overview of DLT and the early cryptos.
What's interesting is how different those early systems were in their approach to, programmability.
Totally. Bitcoin, for instance. It has a scripting language, but it's really quite basic, deliberately so.
Yeah, built for moving value, not complex apps. Security first.
Exactly. Then you had XT, which went a totally different way. High-level API, web tools.
Oh, pre-built functions instead of low-level code.
Pretty much. And then Ethereum landed. Big shift.
With the EVM, the Ethereum virtual machine, and Solidity. Turing complete.
Which basically means you can compute almost anything. Ultimate power for devs.
Open the door for way more complex smart contracts, apps.
But also, more complexity means more potential security headaches. Comes with the territory.
And here's where it gets really interesting. That 2016 paper was already hinting at what might come next.
Yeah, for making contracts better. They mentioned zero-knowledge proofs.
Which is like proving you know something without actually revealing the thing you know. Mind-bending stuff.
It is. And things like proof-carrying code verifying safety before running the contract.
Like automated checks, static analysis.
Exactly. Tools scanning for weaknesses. And Merkleized abstract syntax trees. That's a mouthful.
Huh, yeah. What's the core idea there?
Think of it like a super efficient digital fingerprint for code. Makes verifying its integrity easier.
So they were kind of predicting the push for more secure, more capable blockchain apps.
Seems like it. And they referenced that survey from late 2015, too, showing the big research questions back then.
You can really see the evolution, can't you? From basic scripts to these much more powerful, hopefully trustworthy models.
Absolutely. A clear progression.
All right, moving on. Another huge theme in your reading. Proof of stake. POS.
Oh, yeah. Multiple papers from 2016, 17, 18 dug deep into POS.
Okay, so for anyone newer to this, POS is how the network agrees on new data, right? Based on who owns the most crypto, the stake.
That's the core idea. The crypto holders are key. How much they hold, the stake distribution, drives consensus.
Instead of raw computing power like proof of work.
Right. PS usually picks leaders who propose and validate blocks based more on their stake.
And how are these leaders actually chosen? Is it just the richest?
Not quite. It's often more sophisticated. POS, for example, uses verifiable random functions. VRFs.
VRFs. Sounds technical.
Well, the gist is, each stakeholder uses their secret info and the network state to generate a random number.
Okay.
If that number's below a threshold linked to their stake, they get a shot at being a leader for a specific time slot.
Ah, so it's probabilistic, weighted by stake, but still random for each slot.
Exactly. It ensures fairness and unpredictability, not just richest wins every time. Probability is roughly proportional to stake, but independent each time.
Okay, that makes sense. Now, how does a POS chain actually start the beginning?
The papers mentioned the Genesis block, like in DPoS. It's the very first block.
The foundation.
It contains the list of initial stakeholders and how much stake they each have. Sets the stage.
And from there, new blocks get added. Chain extension.
Right. A chosen leader proposes a new block of transactions. Others check it, verify the leader's digital signature.
And the network decides which chain is the real one. Usually the longest valid one.
No, typically, yeah. The longest chain with valid signatures. One paper mentioned FD plus KT.
Another acronym.
Yeah. Technical detail, but its job is basically helping the network reliably agree on which blocks are good to add. Diffuse and key transaction functionality.
And stake isn't static, right? People buy and sell. How does that affect who becomes a leader later on?
Good question. That's where epochs come in. Many POS systems divide time into these periods, epochs. Your stake at a certain point in the last epoch often determines your leadership chances in the current epoch. So the system adapts over time. It's dynamic.
Like taking snapshots of ownership to influence the future. Got it. Now, randomness is crucial for selecting leaders, isn't it? How is that guaranteed?
Vital. Some use a random beacon. Like DLS uses publicly verifiable secret sharing, PDSS.
PVSS.
Multiple people contribute to a random number, no single person controls it, and the result is checkable.
Clever.
Yeah. And interestingly, while models often use a theoretical random oracle to explain it,
Which doesn't actually exist in reality.
right, but papers note you can achieve similar randomness without it by embedding a shared unpredictable string, a common reference string, right in the genesis block.
So the randomness for the future is kind of seeded right at the very beginning.
Exactly. Planted from day one.
Okay, let's talk security.
Yeah.
The worrying stuff. What are the specific risks with proof of stake?
Several papers hit on this. One big one is divergence, forks, different parts of the network following different chain versions.
Causes confusion, erodes trust.
Definitely. And related to that is common prefix violations, where honest folks might not even agree on recent history. Predictability in leader election makes this worse.
Well, so how easily forks can be made and sustained forkability is a major concern.
It is. That's why they talk about liveness and chain growth.
Liveness means the chain keeps moving forward.
Yeah, the protocol makes progress, adds new blocks. Chain growth is about how fast it extends. There are formal terms like ACQ and CG to measure how well it's working.
Right. Now, attacks. We hear about 51% attacks in proof of work, controlling half the mining power. Does POS have an equivalent?
It does, yes. Though the dynamic is a bit different. If someone controls over half the stake,
They could potentially mess things up, cause forks, stop progress.
in theory, yes, they'd have a very high chance of being able to consistently create alternative chains, undermining finality and liveness.
What about bribing? In Pi Day, you could bribe miners. Could you bribe POS stakeholders?
The papers suggest it might be less effective in POS.
That.
Because the slot leaders, the ones proposing blocks, are also investors, they hold the stake.
So if they attack the system for a bribe.
They risk tanking the value of their own investment if the attack succeeds and the currency crashes, plus losing honest rewards.
Skin in the game creates a disincentive. Not as strong for POW miners who might just sell the coins they mine.
Exactly. Less likely to burn down your own house, right?
Makes sense. The papers also mentioned adaptive corruptions. What's that about?
That's where an attacker strategically compromises participants during the protocol, not just at the start. More sophisticated.
How do protocols fight that?
POS, for example, uses key evolving signatures. Honest participants regularly update their private keys.
So even if an attacker compromises someone,
The old key becomes useless quickly. It's like constantly changing the locks.
Yeah.
Enhances resilience.
constant vigilance. Okay, let's talk specific protocols.
Ouroboros comes up a lot.
Yeah, Ouroboros is foundational. One paper called it the first provably secure POS protocol.
Wow. The first one they could mathematically prove was secure.
Under certain assumptions, yes. It led to a whole family premising. Preos, Genesis, mentioned across several papers.
And Ouroboros Genesis has this bootstrap from Genesis idea.
Hmm.
What's the big deal there? It's huge for resilience, especially with dynamic availability nodes going offline, network issues.
Which happens all the time in the real world.
Exactly. Bootstrap from Genesis means new or returning nodes only need the original Genesis block to sync up.
They don't need to trust anyone else about the history.
Nope, just that first block. And it works without needing assumptions about network speed or how often nodes are online.
That sounds incredibly robust for decentralization. What about instant confirmation in Ouroboros BFT? Sounds fast.
It is significant. If fewer than a third of participants are bad actors, Ouroboros BFT can basically offer instant finality.
So a transaction in a block is considered final almost immediately. No waiting for lots of confirmations.
Pretty much, under those Byzantine fault tolerance assumptions. Big deal for user experience, settlement speed.
Yeah, definitely. Now, POS can lead to stake concentration, right? A few big players. How is that addressed?
Stake delegation is key, mentioned in that 2016 paper.
Letting smaller holders delegate their voting power?
Exactly. They delegate stake to, say, stake pools, who run the nodes and participate in consensus on their behalf.
Spreads the power. Lets small guys participate and earn rewards.
That's the idea. It helps avoid fragmentation. The paper also mentioned an eligibility threshold for delegates.
A minimum amount of stake needed. to stop someone splitting stake tiny amounts.
Right. Prevents gaming the system that way.
And can you take your delegation back?
Yep. Stakeholders can withdraw delegation. The proxy signing keys used by delegates can be revoked via lists on the blockchain itself. Gives control back to the stakeholder.
Okay, cool. Let's shift gears a bit. We've talked consensus. What about deciding the future of the network? Treasury systems, governance?
Right. How the community funds development and makes decisions, covered in papers from 2018 and 2022.
So a treasury system collects funds, maybe from fees or block rewards.
Often, yeah. To pay for ongoing development, maintenance, research, like Dash, Project Catalyst, Decred, they have different models.
A decentralized R&D fund. How do they pick projects?
Usually proposal submission, community discussion, then voting.
And one paper mentioned liquid democracy, delegative voting.
Yeah. Stakeholders can vote directly or delegate their vote to an expert they trust. Combines broad participation with specialized knowledge.
That's clever. How do they make the voting itself trustworthy on a blockchain?
The 2018 paper gets technical. Distributed, universally composable, secure, end-to-end verifiable voting protocols.
Whoa. Okay, break that down slightly.
Basically, it means the voting is transparent, results are verifiable by anyone, and it's resistant to cheating, even by those running the system. They even mention using zero-knowledge proofs for efficiency.
ZKPs again, making it faster and cheaper on-chain. The 2022 paper looked at different types of voting rights. Suffrage.
Right. Identity-based, token-based, stake-based. Each has pros and cons for fairness, security, concentration of power.
And it also hit on key voting properties. Secrecy, verifiability.
Yeah, secrecy, pseudonymity, coercion resistance, verifiability, accountability. Using Polkadot's governance as an example.
Are there trade-offs between those?
Often, yes. Strong secrecy might make verification harder. Polkadot's system, for instance, has public tallies, verifiable, but the voting itself isn't fully private, which affects coercion resistance. But identities are pseudonymous. It's a balancing act.
Definitely tricky. Okay, let's get into smart contracts, those self-executing agreements. We have papers looking at a functional approach and formal verification.
Right. One 2019 paper argues that blockchains are fundamentally functional, immutable ledgers. Changing data is hard.
Which fits well with functional programming, where you focus on data transformation, not changing state.
Exactly. They contrast that with imperative platforms like Ethereum, arguing that the way they handle changing state has led to vulnerabilities.
So build contracts using purely functional languages.
But that's the idea behind Plutus Treeks, mentioned in the 2022 paper. It's a subset of Haskell, the functional language, for Cardano smart contracts.
Okay. And these Plutus Treeks contracts get translated into Plutus Core.
Yep, an intermediate language. And this is where formal verification becomes critical, making sure the contract does what it's supposed to.
Especially with money involved.
Yeah.
How do they verify it? Verifying the whole compiler sounds impossible.
It's often impractical for complex compilers like GHC, yeah. So the paper describes using a certification engine built with Coke, a proof assistant.
A proof assistant.
A tool for writing and checking mathematical proofs. This engine generates a translation certificate for each compilation.
Like a guarantee for that specific translation.
Exactly. It proves the resulting Plutus core code is a valid, accurate translation of the original Plutus TX source code, a verifiable link.
So proving each step rather than the whole tool. Clever.
Provides a very high level of assurance. They even showed an example of code going through compiler passes. The paper also mentioned system EFA. Some deep comp sci foundations there.
High assurance is definitely needed.
Okay.
But let's talk stablecoins. Big topic. Papers from 2021 looked at how they work, how they keep their value stable.
Right. Stablecoins aim for a stable peg, usually to something like the US dollar. The common way is holding reserves fiat-backed.
So for every stablecoin, there's a real dollar held somewhere. Seems simple, but risks involved.
Yeah, managing reserves isn't trivial. Investment risk, the reserves could lose value. Liquidity risk, maybe can't access the cash fast enough if everyone wants to redeem it once.
And issuers might invest reserves to earn interest?
Often, yes. Adds another layer of complexity and risk.
What about algorithmic stablecoins? How do they work without direct reserves?
They use algorithms, market incentives, often involve a reserve currency, RC, and the stablecoin, SC. Papers use math to model the relationship between prices. Reserves held, R, circulating supplies, NSC, NRC.
Sounds like a complex balancing act. Lots of equations in those papers.
Trying to model the conditions for stability, yeah. like comparing expected values of reserves and supplies. Fees on buying selling are also used as levers to incentivize stability.
And they even used calculus, continuous model.
Looking at supply and demand over time, yeah. Modeling buy and sell prices as functions depending on circulating supply, fees, target price. It's an active research area.
Trying to build stable digital money without banks. One paper mentioned the Interhead protocol and Hydra connection there.
Hydra is Cardano's layer 2 scaling solution. Off-chain processing for speed, lower fees.
Okay.
Interhead lets two separate Hydra heads talk to each other. Relevant for stablecoins because it could allow much faster, cheaper transfers between users on layer 2.
Making stablecoins more scalable. Makes sense. All right, let's touch on wallets, how we actually interact with this stuff. Papers from 2020 and 2018 looked at wallet function and security.
The core wallet protocol, yeah. It abstracts away the complexity of managing keys, payment keys, staking keys.
So it handles the tricky crypto behind the scenes when you create an address.
Pretty much. Managing public-private key pairs. The paper also talked about address malleability.
How addresses might be altered.
Yeah, different levels. From full malleability, potential for fakes, to sync malleability, which is stronger but might still allow funds sent to a slightly wrong address, though only the owner can access funds sent to the correct one.
Important security detail. And wallets track UTXOs,
Right.
Unspent outputs, and pending transactions.
Crucial for knowing your actual spendable balance. UTXOs are like your digital coins. The wallet needs to track those, plus outgoing transactions not yet confirmed and incoming ones still processing.
How does it figure out your minimum balance with all that going on?
The 2018 paper explains it has to be cautious. Estimate the minimum by assuming the fewest incoming payments arrive and the most outgoing ones go through.
So it doesn't overestimate what you have available. Conservative is good.
Exactly. The paper also mentioned transaction submission layers the software that broadcasts your transaction and manages pending ones.
Making sure it gets onto the blockchain.
Right. Takes your signed transaction, sends it out, maybe resubmits if needed. It's a whole background process.
Okay, last big topic before we wrap up. Formal methods in development. A 2020 paper argued for combining agile methods with formal ones. Seems like opposites sometimes.
That's the tension, right? Agile is about speed, flexibility. Formal methods are about mathematical proof, rigor.
But the paper says they can work together, especially for critical stuff like blockchain.
Yeah, they argue for fusing them. Get speed and correctness. They used IOHK's experience with Haskell as an example.
How? What's the approach?
Better communication, clear, measurable goals, prototypes based on executable specs, iterative development, regular feedback. Also, refinement-based approaches start abstract, gradually get more concrete.
Applying formal discipline within an agile framework. And functional programming helps bridge that gap.
Big time. Functional programming's focus on pure functions, strong typing, no side effects. It just fits better with formal proofs. Easier to reason about mathematically.
Property-based testing, smaller gap between spec and code.
Exactly. The characteristics of functional languages make them great partners for formal verification.
Makes sense. Okay, a couple of quick mentions from the papers too. Dynamic availability.
We touched on it with Ouroboros Genesis. Real-world networks aren't always fully online. Protocols need resilience. Genesis bootstrapping is a solution. Rejoin using just the first block. No assumptions about past availability or network delay.
Robustness. Another paper mentions simulating a global clock despite network delays too.
Another piece of the puzzle for distributed systems.
And briefly, institutional repositories and interoperability.
Bit of a side note, yeah. But highlights the need for standard ways to share info, like OAI PMH, even in blockchain research. Sharing knowledge effectively.
Finally, a quick mention of financial development, capital markets.
Just context, really. How well-developed markets, bonds, Forex help economic growth, especially in developing countries, and the need for risk management, like hedging Forex risk.
An area where blockchain might eventually play a role, perhaps.
Potentially, yes.
Wow. Okay, so we've covered a ton of ground. Scripting, proof of stake, governance, smart contracts, stablecoins, wallets, formal methods.
It was a deep dive, all right, and some really cool takeaways, like the bribery resistance idea in POS due to stakeholder incentives.
Yeah, that was fascinating. And the bootstrap from Genesis Resilience.
And the serious effort going into formal verification for compilers, that shows a real commitment to trustworthy code.
So our aim, as always, is to give you, our listener, this knowledge efficiently, thoroughly, without the overwhelm. We hope this dive lit up some key areas of blockchain research.
And if something specific caught your ear, maybe a consensus protocol like POS or governance trade-offs or formal verification. There's definitely more to explore out there.
Absolutely. And on that note, here's a final thought to chew on. As all this tech keeps evolving, secure consensus, accountable governance, verified code, stable currencies, how will these pieces ultimately fit together to shape whatever comes next in decentralized systems? Thanks for joining us for this deep dive.